So let's look at this next concept question. On October 1st of 2018, American Medical Inc. adopted a plan to discontinue its generic drug division, which qualifies as a separate component of the business according to GAAP regarding discontinued operations. So the disposal of the division was expected to be concluded by March 30th of 2019. On December 31st of 2018, the company's year-end, the following information relative to the discontinued division was accumulated. We show an operating loss of $195 million, excess of book value over fair value, less cost to sell $25 million. In its income statement for the year ended, American would report a before-tax loss on discontinued operations of A, $170 million, B, $195 million, C, $220 million, or D, all of these answers are incorrect. Well, the correct answer here would be $220 million because it's the $195 million operating loss plus a $25 million impairment loss. The combination here. Another one, the Trident Corporation's results for the year ended December 31st, 2018 include the following material items. We've got sales revenue of $8,200,000, cost of goods sold of $4,800,000, selling and administrative expenses of $2 million, gain on the sale of investments of $300,000, loss of discontinued operations of $1,200,000, and then restructuring costs of $280,000. Trident Corporation's income from continuing operations before income taxes for 2018 is it A, $1,120,000, B, $220,000, C, $1,700,000, D, $1,420,000. So remember, this is from continuing operations. The correct answer here is going to be $1,420,000. We'll take our sales revenue minus our cost of goods sold to get at our gross profit. Then from there we take our operating expenses, which would be our sales and administrative of $2 million. Then we would take and that would be net income from operating. Then we would take our other income and expenses, which would be our gain from the sale of investments, minus our restructuring costs to give us our $1,420,000. Let's now take a look at exercise 4-5. So the following incorrect income statement was prepared by the accountants of a net corporation. We are then required to prepare a multi-step income statement applying GAAP principles, also knowing the income tax rate is 35%. So you see here this is a single-step income statement where it lumps all the gains and then it lumps all the expenses. So the correct manner of a multi-step is to have segments here. The first is the sales revenue minus our cost of goods sold to come up with our gross profit. From there we take our operating expenses to then total them and come up with operating income. From there we take our other income or expenses, where we take our interest, income, and dividend, our interest expense, our gain on the sale of investments, to then show us our income before income taxes. We calculate the income tax expense to then come up with our net income. After that, we would have our earnings per share. Again, we know the earnings per share is going to show the same amount because, again, our net income here was correct. It showed the same amount. Next, Apparel Company had two operating divisions, one manufacturing farm equipment and the other office supplies. Both divisions are considered separate components as defined by generally accepted accounting principles. The farm equipment component had been unprofitable, and on September 1st of year one, the company adopted a plan to sell the assets of the division. The actual sale was completed on December 15th of year one at a price of $700,000. The book value of the division's assets was $1,200,000, resulting in a before-tax loss of $500,000 on the sale. The division incurred a before-tax operating loss of $140,000 from the beginning of the year through December 15th. The income tax rate is 50%. Apparel's after-tax income from its continuing operations is $425,000. Our job? Prepare an income statement for year one, beginning with income from continuing operations. Include appropriate EPS disclosures, assuming 100,000 shares of common stock were outstanding during the year. So, we're going to start with income from continuing operations of $425,000. From there, we are going to have a separate area for our discontinued operations, showing our loss from operations from the discontinued component of $640,000, which is a result of the loss of the sale of assets along with the loss from operations. From there, our income tax benefit, since this is a loss, is going to be a plus $320,000. So therefore, our loss on discontinued operations is a minus $320,000. Now, ultimately, the net income is $105,000, which our earnings per share would be the earnings per share from the continuing operations is the $425,000 divided by the outstanding shares, and then the loss from the discontinued operations is going to be the $320,000 loss divided by 100,000 shares. Emerald Comic Book Company had income before tax of $1,056,000 in year one before considering these items. Emerald sold one of its operating divisions, which qualified as a separate component according to GAAP. The before-tax loss on disposal was $324,800. The division generated before-tax income from operations from the beginning of the year through disposal of $464,000. Neither the loss on disposal nor the operating income is included in the $1,056,000 before-tax income the company generated from its other divisions. The company incurred restructuring cost of $75,000 during the year. Our job? Prepare an income statement for Emerald beginning with income from continuing operations, assuming an income tax rate of 25%, and we don't have to worry about the EPS disclosures. So, we know our income from continuing operations, it was given to us of $1,056,000. Then our decrease due to restructuring cost is a minus $75,000. Before tax income from continuing operations then is a $981,000. We add our income tax expense of the percent times the before tax income from continuing operations to give us the $245,250 expense. The net here would be the income from continuing operations. From there, we are going to do continue on with the discontinued operations, which would be the income from operations of the discontinued component, showing our loss of disposal of the $324,000, then including our income tax expense to show us then ultimately the net income of the income from continuing operations along with our income from discontinued operations gives us our net income of $840,150. Exercise 4.8, Venn Enterprises, has two operating divisions. One manufactures machinery, the other breeds and sells sheep. Both divisions are considered separate components as defined by GAAP. The sheep division's been unprofitable, and on October 15th, Venn operated a formal plan to sell the division. The sale was completed on April 30th of year 2. At December 31st, the component was considered held for sale. On December 31st, year 1, the company's fiscal year end, the book value of the assets of the sheep division was $30,000. On that date, the fair value of the assets less the cost to sell was $24,000. The before-tax loss from operations of the division for the year was $12,000. The loss. The company's effective tax rate is 30%. The after-tax income from continuing operations for year 1 was $42,000. First, we're going to prepare a partial income statement for year 1, beginning with income from continuing operations, ignoring EPS disclosures. Then, the next step will be repeat requirement 1, assuming that the estimated net fair value of the sheep's division assets was $42,000 instead of the $24,000. So, what we're going to show here is our loss from operations, then our impairment loss of minus $6,000, our net tax before tax loss of minus $18,000. Since this is a loss, we have an income tax benefit to give us our net loss after tax on discontinued operations is a minus $12,600. Instead of now the $24,000 impairment loss, that stays the same. It's the income from continued operations that changes. We then show a loss from operations of the discontinued component stays the same, along with our income tax benefit. Our net income here is our income from continued operations of $42,000. Subtract that, our loss of discontinued operations of $12,600 gives us our net income here of $29,400. Then, for the second requirement, we are going to assume that the sheep's division's assets, instead of it being $24,000, is $42,000. So, in this scenario, we've got continued operations, then we've got our loss from operations of minus $12,000, plus the income tax benefit gives us our loss from discontinued operations with then a net income of $33,600. In this scenario, since we don't have an impairment loss, we only then show the operating loss. Next, on September 17th, Zenmark entered into an agreement to sell one of its divisions that qualifies as a component of the entity according to GAAP. By December 31st, the company's fiscal year end, the division hadn't sold but was considered held for sale. The net fair value minus cost to sell of the division's assets at the end of the year was $11,512,000. The pre-tax income from operations of the division during year one was $4,867,000. Pre-tax income from continuing operations for the year totaled $14,930,000 with a income tax rate of 30%. Zenmark reported net income for the year of $7,174,000. We are supposed to determine the book value of the division's assets on December 31st of year one. So our pre-tax from continuing operations was given to us of $14,930,000. We'll calculate our income tax expense to then come up with our income from continuing operations. From there, we will show our discontinued operations. They gave us the net income, so from there we would have to subtract the income from continuing operations minus our net income to know what our loss from discontinued operations is. We can then plug back to get the income tax benefit and then determine what the income from the operation of the discontinued component would be. So basically in this scenario we have a couple figures, and as a result of our net income we have to go backwards in order to calculate what that income from operation of the discontinued component would be. Our operating income from the discontinued segment of $4,867,000. Our gain or loss from our disposal would be $9,548,429 to then give us our loss from the operation of the discontinued segment. Now for impaired loss, the $9,548,429 plus the estimated market value of $11,512,000 that was given to us would then equal what our book value would be, the $21,060,429. The purpose of this exercise is so you can understand the various aspects of the income statement and how you can derive or calculate the specific figures based on the information that's being provided. Now, accounting changes fall into one of three categories: a change in an accounting principle, a change in estimate, or a change in reporting entity. The correction of an error is another adjustment that gets accounted for in the same way as certain accounting changes. A change in accounting principle refers to a change from one acceptable accounting method to another. There are many situations that allow alternative treatments for similar transactions. Common examples would include like choices among LIFO, FIFO, and average cost for the measurement of inventory, and among alternative revenue recognition methods. New accounting standard updates issued by FASB also may require companies to change their accounting methods. Sometimes FASB requires a change in accounting principle. These changes in accounting principles can hamper the ability of external users to compare financial information among reporting periods just because the information can lack some consistency. So the board considers factors such as this, as well as the cost and the complexity of adopting these new standards, and then chooses among various approaches that require this implementation by companies. There's a retrospective approach, where the new standard is applied to all periods presented in the financial statement. So we restate prior period financial statements as if the new accounting method had been used in those periods. Then we revise the balance of each account affected to make those statements appear as if the newly adopted accounting method had been applied all along. Then there's a modified retrospective approach where the new standard is applied to the adoption period only, and prior period financial statements don't get restated. The cumulative effect of the change of prior periods net income is shown as an adjustment beginning balance of retained earnings in the adoption period. Then last we have the prospective approach, where this requires neither a modification of prior period financial statements nor an adjustment to the account balances. Instead, the change is simply implemented in the current period and all future periods. So without being required by FASB, a company will change from one generally accepted accounting principle to another. Example would be a company may decide to change its inventory method from LIFO to FIFO. So when this occurs, inventory and cost of goods sold are measured in one reporting period using LIFO, but then are measured using FIFO in a future period. Inventory and cost of goods sold, and then as a result net income for the two periods aren't really comparable. So to improve that comparability and consistency, GAAP generally requires that voluntary accounting changes be accounted for retrospectively. A change in depreciation, amortization, or depletion method is considered to be a change in an accounting estimate that's achieved by a change in accounting principle. We account for this change prospectively, almost exactly as we would any other change in estimate. One difference is that most changes in an estimate don't require a company to justify the change. However, this change in estimate is a result of changing an accounting principle, and as a result requires a clear justification as to why a company chose this new method and why that is preferable. Estimates are a necessary aspect of accounting. A few of the more common accounting estimates are the amount of future bad debts on existing accounts receivable, the useful life and residual value of a depreciable asset, and then future warranty expenses. Because estimates require the prediction of future events, it's not unusual for them to turn out wrong. So when an estimate's modified as new information comes to light, accounting for the change in estimate is pretty straightforward. We don't revise prior year's financial statements to reflect the new estimate. Instead, we incorporate the new estimate in any related accounting determinations from that point on, which means we account for a change in accounting estimate prospectively. If the effect of the change is material, a disclosure note is needed to describe the change and its effect in both net income and in earnings per share. Errors occur when transactions are either recorded incorrectly or not recorded at all. Accountants employ various control mechanisms to ensure transactions get accounted correctly. But in spite of this, errors still happen. When they do, they can affect any one or several of the financial statement elements on any of the financial statements a company prepares. In fact, many kinds of errors simultaneously affect more than one financial statement. When errors are discovered, they should be corrected. Most errors are discovered in the same year they're made. These errors are simple to correct. the original erroneous journal entry gets reversed and the appropriate entry gets recorded. If an error is discovered in a year subsequent to the year the error is made, the accounting treatment depends on whether or not the error is material with respect to its effect on the financial statements. In practice, the vast majority of errors are not material and are therefore simply corrected in the year discovered. However, material errors that are discovered in subsequent periods require a prior period adjustment. Now assume that after its financial statements are published and then distributed to shareholders, Rouge Distribution Company discovers a material error in the statements. What's it do? Well, Rouge must make a prior period adjustment. Rouge would record a journal entry that adjusts any balance sheet accounts to their appropriate levels and would account for the income effect of the errors by either increasing or decreasing the beginning retained earnings balance in a statement of shareholders' equity. Remember, net income in prior periods was closed out to retained earnings, so then by adjusting retained earnings, the prior period adjustment accounts for the error's effect on the prior period net income. Simply reporting a corrected retained earnings amount could cause misunderstanding for someone familiar with the previously reported amounts. Explicitly reporting a prior period adjustment in the statement of shareholders' equity or the statement of retained earnings, if that's presented instead, highlights the adjustment and thus would avoid any confusion. In addition to reporting the prior period adjustment as retained earnings, then previous year's financial statements that are incorrect as a result of the error are retrospectively restated to reflect the correction. There also needs to be a disclosure note that communicates the impact of the error on prior periods' net income. We've discussed that the income statement reports a company's net income for the period. Net income is reported in total dollars, which is total dollars of revenues minus total dollars of expenses, and represents the total profits that a company's generated for all shareholders during the period. However, for individual decision-making, investors want to know how much profit's been generated for each shareholder. So to know this, we have to calculate the earnings per share to relate the amount of net income a company generates to the number of common shares outstanding. EPS provides a convenient way for investors to link the company's profitability to the value of an individual share of ownership. The ratio of stock price per share to earnings per share, which we would call the PE ratio, is one of the most widely used financial metrics in the investment world. EPS also makes it easier to compare the performance of the company over time and with other companies. Larger companies may naturally have larger dollar amounts of net income, but they don't always generate more profit for each shareholder. U.S. GAAP requires that public companies report two specific calculations of earnings per share. One is the basic earnings per share, and then one is the diluted earnings per share. So the basic earnings per share equals the total net income less any dividends to preferred shareholders divided by the weighted average number of common shares outstanding. Dividends preferred shareholders are subtracted from net income in the numerator because those dividends are distributed by the company. They're not available to the common shareholders. The denominator is the weighted average of common shares outstanding rather than the number of shares outstanding at the beginning or end of a period, because the goal is to relate performance for the period to the shares that were in place throughout the period. The number of common shares may change over the year from additional issuances or company buybacks like treasury stock, so a weighted average better reflects the number of shares outstanding for the period. The resulting earnings per share provides a measure of net income generated for each common shareholder during the period. So for example, suppose Fetzer Corporation reported net income of $600,000 for its fiscal year end. Preferred stock dividends of $75,000 were declared during the year. Fetzer had 1 million shares of common stock outstanding at the beginning of the year, and it issued an additional 1 million shares on March 31st, 2018. So the basic EPS of 30 cents per share for 2018 is shown here. We take the 600,000 minus the dividends to preferred of 75. We divide that by our original shares outstanding plus the shares that were issued in March. So we only take 9 months of those shares since they weren't out for the whole year to calculate an average of outstanding shares. From there, that calculation provides us with our 30 cents per share. Diluted earnings per share incorporates the dilutive effect of all potential common shares in the calculation of EPS. Dilution refers to the reduction of EPS that occurs as the number of common shares outstanding increases. Companies may have certain securities outstanding that could be converted into common shares, or they could have stock options outstanding that create additional common shares if the options get exercised. Because these items could cause the number of shares in the denominator to increase, they potentially would decrease the earnings per share. So when the income statement includes discontinued operations, we report per share amounts for both income from continuing operations and for the net income or loss from the discontinued operations. So we see this demonstrated for Abbott Laboratory here. So let's look at exercise 410. The Inmark Import Company had 1.14 million shares of common stock outstanding during year 1. Its income statement reported the following items: income from continuing operations of $4.78 million, loss from discontinued operations of $1.39 million. All of these are net of tax. So our job is to prepare in year 1 earnings per share presentation for the Inmark Import Company. So our income from continuing operations is $4.78 million. The loss from discontinued operations is a minus 1.39 with net income of 3.39. Our earnings per share from continuing operations is going to be $4.19, which is our $4.78 divided by 1.14 million shares. And then our loss, EPS, would be the 1.39 million loss, then divided by our number of shares outstanding to give us a minus 1.22 cents per share. Ultimately, our net income per share would be the $4.19 minus the $1.22 to give us $2.97 per share. Let's take a look at a question. Which of the following represents a change in accounting principle? A, using a journal entry to correct a misstatement in current year financial statements. B, changing inventory costing method from LIFO to average cost. D, modifying the amount of bad debt expense in accounts receivable as new information on customer insolvency is obtained. Or D, correcting a material error in financial statements that have already been released to investors. So, of course, the correct answer here is B, changing inventory from LIFO to the average cost method. Number C is an estimate, a change in an estimate, and A and D are corrections of accounting errors. Net income, as we've already talked about, includes all revenues, expenses, gains, and losses reported in the income statement. Comprehensive income provides a broader perspective of income and includes all revenues, expenses, gains, and losses for the period. In other words, comprehensive income includes net income plus other changes in shareholders' equity that do not represent transactions with owners. Accounting professionals have engaged in an ongoing debate concerning whether certain gains or losses should be included as components of net income or as part of other comprehensive income, and then how comprehensive income should be reported. So FASB decided to maintain the traditional view of net income, requiring the income statement, but also to require companies to report the expanded concept of comprehensive income. The calculation of net income omits certain types of gains, losses, or other adjustments that are instead included in other comprehensive income. So, for example, certain investments are reported in the balance sheet at their fair values, but that the gains and losses resulting from adjusting those investments to fair value might not be included in net income. They get reported in the comprehensive income or loss. Companies must report both net income and comprehensive income and reconcile the difference between the two. Be sure to remember that net income actually is part of comprehensive income. This reconciliation simply extends net income to include other comprehensive income items reported net of tax. The information in the income statement and other comprehensive income items can be presented either in a single continuous statement of comprehensive income or in two separate but consecutive statements, an income statement and then a statement of comprehensive income. This shows the top comprehensive income, and then we show comprehensive income presented as a separate statement. Now, each component of other comprehensive income can be displayed net of tax or alternatively before tax with one amount shown for the aggregate income tax expense or benefit. Some companies choose to present comprehensive income in a single statement. On the other hand, in its financial statement here, Astromed Inc., a manufacturer of a broad range of specialty technology products, chose to use the separate statement approach as you see here. In addition to reporting OCI that occurs in the current reporting period, we must also report these amounts on a cumulative basis in the balance sheet. This is consistent with the way we report net income for the period in the income statement and also report accumulated net income that hasn't been distributed as dividends in the balance sheet as retained earnings. We report OCI for the period in the statement of comprehensive income and also accumulated other comprehensive income in the balance sheet. This gets shown here on this slide. So supplementing information here with numbers reported on the previous slide along with dividends declared by Astromed, we then can reconcile the changes in both retained earnings and AOCI. So to further understand the relationship between net income and other comprehensive income, let's take a look at this. Phillips Corporation began the year with retained earnings of $700 million and accumulated other comprehensive income of $30 million. Let's also assume that net income for the year before considering the gain talked about here is $100 million, of which $40 million was distributed to shareholders as dividends. Now assume that Phillips had a $10 million net of tax gain that was also reported in one of two ways, either as gain in net income or as a gain in other comprehensive income. Under the first alternative, the gain would be included in shareholders' equity through retained earnings. Under the second alternative, the net of tax gain of $10 million is reported as a component of other comprehensive income or loss. So the gain will be included in shareholders' equity through accumulated other comprehensive income rather than retained earnings. The total of retained earnings and accumulated other comprehensive income is $800 million either way. Net income and comprehensive income are identical for an enterprise that has no other comprehensive income items. When this occurs for all years presented, a statement of comprehensive income isn't required. Components of other comprehensive income get talked about in other chapters. So both U.S. GAAP and IFRS allows companies to report comprehensive income in either a single statement of comprehensive income or in two separate statements. Other comprehensive income items are similar under the two sets of standards. However, an additional OCI item, changes in revaluation surplus, can be possible under IFRS. We're going to learn about this later in a chapter, how certain IAS 1629 permits companies to value property, plant, and equipment at cost less accumulated depreciation or at fair value. So we'll talk about that in the future. Now let's look at an exercise. Exercise 411. The Maven Consulting Group reported net income of $1,314,000 for its fiscal year ended December 31st, year 1. In addition, during the year, the company experienced a foreign currency translation adjustment gain of $252,000 and had unrealized losses on investment securities of $84,500. The company's effective tax rate on all items affecting comprehensive income is 35%. Each component of other comprehensive income is displayed net of tax. So we're going to prepare a separate statement of comprehensive income for the year. So we show net income, which is given to us. Then we include our title, Other Comprehensive Income, foreign currency translation gain net of tax. We know the gain was $252,000, but we net the tax of $88,200 to then show $163,800 is ultimately what we show our gain due to the income tax we need to pay. The unrealized losses on investment securities net of tax benefit is $29,575. When we take into account the tax rate, we then receive a loss of $54,925. So our total other comprehensive income would be $108,875. We take our net income. From there we add our comprehensive income to give us our total comprehensive income of $1,422,925. $875. Now let's look at a question. Which of the following is not an example of other comprehensive income? Income from sales, unrealized loss on securities available for sale, foreign currency translation adjustments, or deferred gains from derivatives. I sure hope you get this one. Income from sales is not an example of other comprehensive income. It's the reason we're in business. And so it's a component of comprehensive income, but it's net income from operations. We're going to end here and pick up with the next lecture.